English voiceover script, keyword inserted 5 times. Channel, the crypto compass, main keyword, crypto investment. Today we're going to talk about a topic that almost everyone loves, everyone is curious about, and at the same time, it scares a lot of people. Comparing crypto returns over 10 years. 10 years, not 10 weeks, not 10 months. 10 years is a brutally honest test. 10 years is where reality shows up. And let me tell you, this market can be ruthless, but it is also fair. It doesn't care who you are. It doesn't care who you listen to, who you follow, who you copy. It only cares about one thing. Can you survive long enough to win? Before we jump into the numbers, I want you to understand this. Comparing returns in crypto is not just about looking at percentage gains. If you only look at percentage gains, you're like someone who only looks at the stage lights and thinks show business is all glamour. No. Crypto is a triathlon: returns, risk, and endurance. You can have massive gains, but if you can't handle a 70%, 80%, even 90% crash, then those gains were never really yours. They were just a fantasy on a screen. That's why the phrase, comparing crypto returns over 10 years, has to mean something deeper than a leaderboard of who pumped the most. To compare correctly, we need at least 4 measurements. 1. Total return, how many dollars your $1 becomes. 2. CAGR, compound annual growth rate, because 10 years is a compounding story, not a one-season explosion. 3. Maximum drawdown, how deep the worst drop was, because that determines whether you get kicked out of the game. 4. Volatility, because volatility is what makes you lose sleep, and it's also what makes people panic sell the bottom. If you understand these 4, you start thinking like an adult in crypto investment. Now let's talk about the 10-year window. If we're measuring up to early 2026, we're looking roughly from 2016 to 2026. That period is long enough to include multiple cycles: bull markets, bear markets, recoveries, hype, collapses, and the classic story of, I thought it would come back to its all-time high. You'll see something fascinating. Some coins rise hard for a while, then disappear. Some projects were called the future, and later they became the past. And some assets don't need to promise the world. They simply survive, mature, and get validated by time. I'm going to be very direct. When you look at 10 years, Bitcoin stands out like a monster. The longer the timeline, the more it shows its core strength. It's like a foundation. It doesn't have to talk. It just has to exist and keep being accepted. And Ethereum, despite endless debates, has remained a pillar of infrastructure, though it comes with technology risk and fierce competition. You can love it or hate it, but you can't ignore the fact that over long horizons, these names often sit at the center of the story. But don't misunderstand me. I'm not saying just buy BTC and ETH and you're done. No, I'm talking about how you read data. When you compare 10-year performance, you must watch out for one of the biggest traps in the world: survivorship bias. What does that mean? It means you only look at the winners who survived and forget the thousands that vanished. If you only study the survivors, you'll think this market is easy. It's not easy. It rewards people who manage risk and choose assets that can actually live through time. Here's the part you need to hear clearly. Big returns are not the same as durable returns. You might catch an altcoin that goes 50 times or 100 times. Great. Fantastic. But if it later drops 95% and never recovers, the real question is, where did you take profit? Did you have a system for selling? Or did you turn yourself into a bag collector, holding a pile of things that only bring regret every time you look at them? 10 years turns promises into ash and turns real foundations into real assets. Now let's talk about fair comparison. If you choose one single start date and one single end date, you can bend the result. Start at the exact bottom and end near the top, and everybody looks like a genius. Start near the top and end in a bear market, and the picture flips completely. That's why serious analysis uses multiple methods: monthly closes to reduce noise, multiple start points to avoid cherry picking, And the most practical one of all, DCA, dollar cost averaging, monthly contributions over 10 years, which is much closer to how real people behave. And here's what's interesting. DCA often creates a more realistic story. It shows who can stay, who quits, and who wins through discipline. In crypto investment, DCA is not magic. It's discipline. It's a strategy designed to fight your emotions, because emotions are the fastest way to get destroyed. When the market pumps, you get greedy. When it dumps, you get scared. And you become a machine that buys high and sells low. DCA breaks that loop. It won't make you rich overnight. It helps you exist long enough to get rich. And it also forces you to ask a more serious question. What am I buying? And why am I still buying it when nobody is cheering? Now let's bring benchmarks into the picture. When you put crypto next to the S&P 500, gold, or even just inflation, you'll see periods where crypto looks unbelievably strong. But that strength comes with brutal drawdowns. The S&P 500 rarely drops 80% in a normal cycle, while crypto can do that like it's a habit. So saying crypto has higher returns can be true, but it's incomplete. The real sentence is, higher returns, paid for with what price? That price is volatility, psychology. This is where maximum drawdown matters. I want you to picture this. You have 100. The market falls, and you're left with 50. You need a 100% gain just to get back to 100. Now it falls harder, and you're left with 20. You need a 400% gain just to get back to 100. Do you see it? The deeper the fall, the harder the recovery. That's why when you see a coin down 90%, don't say it only needs 10 times to return to the top. No, it needs capital inflows, trust, narrative, liquidity, time, and a lot more. Many coins never come back. 10 years will prove that. And that's why serious investors ask a different question. Can this survive 2 or 3 full cycles? If not, you are gambling, not investing. Next, let's talk about CAGR. CAGR is clean, it's elegant, it's grown up. It answers, on average, how much did this asset grow per year, compounded? If something goes 10 times in 10 years, the CAGR is roughly 25 to 26% annually. If something goes 100 times in 10 years, the CAGR is around 58 to 59% annually. Those are powerful numbers. But remember, it's an average. The real path of crypto is not smooth. It's a roller coaster. It shoots up, it crashes down, it shoots up again. If you look at CAGR and ignore drawdown, you are hypnotizing yourself with a pretty number. So what's the educational message here? If you're making a video on comparing 10-year returns, you're not just ranking coins by profit. You're teaching people how to think about risk and time. You're teaching that crypto investment done seriously is like building a business. Strategy, reserves, discipline, capital management, periodic reviews. It's not an emotional all-in game. It's not, I feel lucky today. It's, I'm prepared for next year and the year after that. Now I'm going to give you a simple 10-year checklist. It's simple, but it's powerful. 1. Do you have allocation? Or are you throwing everything into one thing? 2. Do you have a profit-taking plan? Or are you just holding forever and hoping? 3. Can you handle a 70% drawdown? If you can't, your risk is too high from the beginning. 4. Do you have cash reserves? Because you will need them when real opportunity shows up. 5. Can you explain why you bought it? If you can't explain it, that's a danger signal. And here's the point I want to hit hard. Most people lose not because they chose wrong at the beginning. They lose because they can't survive the middle. They don't have a system. They don't have discipline. They stare at charts every day like they're watching a ticking clock in an exam room. They exhaust themselves. 10 years is a long journey. You don't win by guessing right today. You win by building a process you can follow tomorrow, next month, next year. If you're making this video, tell your audience something critical. Don't let a beautiful chart fool you. A coin can have a glorious past, but the future is not guaranteed. A project can have world-class marketing, but in the end, the market rewards what has real value. What survives? What withstands time? That's why in crypto investment, the biggest question is not, will it go up? The biggest question is, will it live? Live through cycles, live through crises, live through technology shifts, live through narrative wars. Let's close with 3 lessons. 1. Comparing 10-year returns must include CAGR, drawdown, and volatility. Don't just look at a percentage gain. 2. Use multiple measurement methods, monthly closes, multiple start points, and DCA to avoid being tricked by a single lucky date. 3. The goal isn't to become someone who guesses right. The goal is to become someone who survives long enough. The market will keep rising and falling. The noise will keep getting louder. The promises will keep coming. But the truth is simple. The person who manages risk better, the person with stronger discipline, the person who truly understands what they're doing, wins. If you want to go 10 years, act like a builder, not a gambler. Learn. Take notes. Make rules. Respect risk. Do that, and you won't need a miracle. You'll just need time. And time in this market is what creates the biggest stories. Because in the end, it's a long game. Build survival, build skill, and let compounding do its job. That is what crypto investment is really about.